dive more into these bank earnings and what it all means for investors. Joining us now, we've got Interactive Brokers Chief Strategist Steve Sosnick, along with Odeon Capital Group Financial Strategist Dick Bove. Great to have you both here with us today. Steve, I want to start things off with you. Give us your 10,000-foot read on what we've seen from the banks thus far and kind of what it sets up for the health of the economy and really where the consumer finds themselves right now.
Good morning, Brad. I think right now the investors are being a bit discerning. I think we were coming into this with a bit of a fear factor of which banks might disappoint. We still haven't really heard from the ones that I think are more vulnerable, and I'll let my esteemed other guest get into that in a bit. But we basically, we're distinguishing which banks are the leaders, which are the losers. I've never loved the idea that banks lead off earnings season because we start talking about things like fixed income trading revenues and stuff of that nature, which have no impact on any other business anywhere in the country, or even to a large extent other banks. But this time it was very important just to hear what, let's get things kicked off. I think we learned that J.P. Morgan is really, the biggest among big. I called Jamie Dimon, Bruce Springsteen, and the rest of the other bankers the E Street Band. But that's kind of the role they showed that they have. And we're learning case by case. MTB they loved, State Street they didn't. So I think we're getting pretty discerning. And I do think we want to see, but I do think people are happy to see that for the most part, there's not pervasive trouble, at least that we've seen so far.
And Dick, I want to get your take as well, because given the expectations going in, a lot of the panic that was surrounding the banking scare, in terms of your reaction then to what we're seeing with these bank earnings and perhaps what we should be keeping an eye on as we keep in mind it might not tick in until the next set of earnings. What are you keeping an eye on here?
Well, I think what they're doing in banking is most important. In other words, generally speaking, people would look at year-over-year numbers when assessing, bank results because this is it's a cyclical industry and it's a seasonal industry. But this time around, I think it's important to take a look at the quarter-over-quarter results because the world is different. I mean, we are not in a low interest rate environment. We are not in a situation where the Fed is expanding its balance sheet. It's shrinking its balance sheet. So I think the quarter-over-quarter numbers in banking are most important. And when you go through each one of the banks, whether it's J.P. Morgan, Wells Fargo, Bank of America today, what we're seeing is, little to no growth in loans. Most of them show declines in loans. Virtually no growth in deposits. Virtually all of them showed declines in deposits. We're seeing an increase in loan losses, and the increase is highly associated with consumer activity. And we're seeing, that their margins are under stress. And if we were to narrow it down to just the last month, the month of March, it would appear that there's negative numbers in all of those respects. And I think that's what, you have to look for in terms of going forward. And what Steve said was incredibly important. He said that nowhere else in the world do they care about what the trading results are, for banking companies. And that's absolutely correct, because basically all of the increase in profits that we've seen on a quarter-over-quarter basis have come from trading. And the fact that people are sitting all over Goldman Sachs today doesn't seem to be quite correct because, Goldman's fixed income trading quarter over quarter was up 66%, and their net income in the quarter, again, quarter over quarter, was up 161%. So when David Solomon says this is a litmus test, he was thinking that we did a pretty good job in the quarter. Everybody else is saying, well, wait a minute, we want to look year over year, and we don't think you did so great year over year. But Goldman actually had very strong results in the quarter, and Bank of America, like its peers, showed weakness in all of its banking activities, and I think that's what people have to start thinking about.
Hey, Dick, just while we're with you, 1 second, I want to also ask about the loan provisions that each of these banks have set aside in one capacity or another. Is there anything that you look at within the loan provisions that have largely increased across the board for the banks right now that is still tied back to the banking turmoil that took place in March and them trying to really get a wrap around what is still perhaps yet to come on an economic standpoint, where we had Bank of America and Brian Moynihan doubling down, or at least reiterating their forecasts for a Q3 2023 recession to begin at that point.
Yeah, well, you do have to disaggregate the loan loss number. It's composed of two elements. Element number one is, what did the banks actually lose on their loans? And element number two is, what do we estimate they will lose in the future? And if you take a look at every one of these banks, every one of them, they showed a significant increase in the actual loan losses. And in the case of some of them, like Bank of America, they made the assumption, which was, in my view, totally hypocritical. You can't say, that we estimate fewer loan losses in the future and then say, that we think there's going to be a recession. But what you have to focus on, forget the loan loss provision, look at the actual charge-offs. The actual charge-offs were negative. And they're negative because there's been too many credit card loans made. They're negative because the inflation rate is too high. They're negative because auto loans, prices are dropping below where these people actually bought the cars for, and they hooked them into 7 and 10-year loan agreements on these cars, which are declining in price. So the consumer is going to create a great deal of difficulty for traditional banking going forward. But as I said, bottom line, a bank has to take in more money. They're not doing it. The deposits are going down. They've got to make more loans with that money. They're not doing that either. What they're doing is they're making a heck of a lot of money trading. And that's not the core business of the banking industry. The core business is not doing well. And that's what you're going to look at over the next 3 quarters this year. You're not going to be looking at trading. You're going to be saying, what went wrong with net charge-offs? What went wrong with why we can't hold on to deposits? What went wrong with why we're not increasing our loans? And therefore, my view, since this rally started, was people are relieved that the banking industry is not in disastrous shape. But what they're really focusing on is what they really should be focusing on is these quarter-over-quarter results are showing a serious deterioration in banking, and that's not what you want to buy into.
And Steve, I want to bring you in here because obviously we're seeing a lot more tech companies getting into this space, notably when it comes to Goldman Sachs, helping Apple with its very high interest rate accounts here now, and essentially more than what they would get if they were with Marcus. What position is Goldman Sachs putting themselves in right now?
I don't know, because I have a Marcus account, and I was quite happy to see that they raised my rate, only to find that I'd be better off if I had it at Apple. Goldman, it's a tough time unpacking that specific strategy. I understand why they want to broaden their customer base. I mean, they've always had a very rarefied customer base, which has served them well. But so far this has not been. The consumer has not been in their wheelhouse, and they haven't figured out how to monetize it. It's been a money loss for them, and I'm sure it's a huge distraction. And so, Apple, of course, having, perhaps one of the greatest customer bases in the world, fully locked into their ecosystem. I understand it, but I'm at a bit of a loss to explain why they would, give 25 why they basically would lose 25 basis points, or forgo 25 basis points for someone else to white label their offering. Doesn't make a lot of sense to me, but again, I've been a bit mystified, but I will say as a consumer, I've taken advantage of some of their high rate products.
Well, exactly. I'm sure the customers everywhere are smiling about that. A big thank you to our guest, Interactive Brokers Chief Strategist Steve Sosnick and Odeon Capital Group Financial Strategist Dick Bove. Thank you for joining us this morning.